if that North Star takes a very long time and a large amount of money before you figure out whether you're right or wrong, you do need to have some more near and midterm strategies to create a viable business.
Hi everyone, I'm Rainier, one of the founders of ArmasTec, and today we have Joseph, the managing partner of Verge HealthTech Fund. And we're going to talk about what it takes for a hardware startup to get money, especially in this kind of cold fundraising environment. So yeah, let's get right into it. Thanks Joseph, and good morning to you. Thanks for taking the time to meet with me today. So, funny thing, like when you're fundraising, you have to build up a list of investors, right, that you want to connect to. And funnily enough, you were in that list. And I always try to go in warm, not just to send a random email that you probably get 100 of those every week. So I tried to go in warm. I was looking for a connection, and I was about to send a cold email because I really couldn't find one. Then there comes Rahul asking me to do a podcast, and lo and behold, I'm talking to Joseph. So
Cool.
That has been pretty serendipitous, and I would like to say lucky. And I want to use that to segue actually to my first question, because one of the things that you hear is that luck plays kind of an important role in making a successful startup, right? But you, as a prospective investor, how do you judge a founder's ability to capitalize on the opportunities that falls into their lap? Because as CEO, I think one of our main jobs is to take whatever opportunity lands in our lap and milk it for all it's worth. So how do you judge that?
That's a really interesting way of hearing it phrased. I was afraid for a moment you're going to ask me to judge a entrepreneur's degree of luck. And that would have been a little bit scary if you were to ask me that question. I actually look at things a little bit different. So there are two types of entrepreneurs in this world, or maybe there's a spectrum rather of entrepreneurship, or entrepreneur, sorry. One being, the total mercenary who's like, here's a great opportunity, I'm going to go chase it because it's a great opportunity, versus a missionary, which is, this problem really bugs me and I'm going to spend every ounce of my energy trying to solve this problem.
I gotcha.
And now this isn't necessarily the right answer, but this is the answer that I tend to gravitate to as more of the missionary type. They see a problem, they're fundamentally bothered by it, maybe it affected them personally, and they spend every waking moment trying to solve that problem. And I find that founders that tend to be more missionary in nature are more resilient to the ups and downs that entrepreneurship brings and the journey that comes with it, especially in deep tech or areas that are regulated, things that take a little bit more time and money to get to a certain proof point than your typical, software SaaS startup. So I think that's one of the key distinctions, and that's kind of one of the traits that I look for. Not all investors are the same. Some investors will say, hey, you've come across a great fundamental opportunity. You should strike while the iron's hot and, pursue it with all you can and see if you can capture it. I don't necessarily follow trends so much. I mean, you have to be cognizant of them, but I'm still fundamentally a problem-based investor.
I gotcha. I mean, that's also kind of interesting to hear, right? Because to me, what that sounded like was that you were almost comparing the motivation types of different founders, right? Whether it's internal motivation, like I really care about this and I want to solve it, versus, oh, that sounds something interesting to do, maybe let me try and take a stab at that. How do you value, or what type of value do you assign to a founder's motivation? I mean, do you think that a founder that is internally motivated is generally more likely to succeed than one who's externally motivated?
I would think so.
Yeah.
I don't have hard data on it, but I would think so, given that the only reason a startup ever fails is if the founder quits or the founder dies.
Like literally.
Yeah.
Yeah. Okay.
And if you're intrinsically motivated versus extrinsically motivated, are you more likely or not to quit?
Okay.
And then the other dark side of this is that a founder may not know when to quit. And a founder that is extrinsically motivated will have a higher likelihood of knowing when to quit. And there have been stories of founders that have actually just driven themselves personally into the ground trying to not quit.
I see.
And you hear about the stories where it worked out fantastically well. It's like the founder's bank account went negative 3 times and they turned this into a great success. But you don't hear about the founders whose bank accounts hit negative 3 times and then, what happens to them after? Some dark things can happen.
Yeah.
That's survivorship bias.
Yeah, I mean, you only hear about the success stories and never the ones that, well, you don't want to hear about, that you kind of pretend they're not there.
Yeah, unless they're like absolutely tragic, then they make headlines for the wrong reasons, unfortunately.
Yeah. Okay, maybe let's not get into that. Yeah.
No, it's very dark for this time in the morning.
I just wanted to ask you one question for the benefits of our listeners out there, because I think one of the most common motivators that you ask someone who isn't a founder yet, but say you ask them, do you want to do a startup? Yeah, I want to do a startup. I want to be a billionaire. I want to make millions. What is your suggestion, I guess, or advice to someone whose motivation is really just to make a ton of money?
Go into banking or consulting. No, sorry, that was very facetious.
Yeah.
I don't. And again, this is a very personal philosophy.
Yeah.
And probably sounds a little bit weird as an investor. And I don't like to see money as a primary motivator. If money is a primary motivator, go into trading. Actually, not even. I think some of the best traders like the game. Sorry, let's take that back. But going into a finance related field where it's the study, manipulation, exchange services around money is probably going to give you a higher likelihood of getting money.
I gotcha.
If your love of money is that great. I think money is a byproduct of solving an important problem and creating value for as many people as possible, or creating incredible amounts of value for a select few.
I gotcha. Yeah, well, okay. That pretty much confirms what I thought I know. So I did know it. I want to switch gears here a little bit, because one of the reasons why I wanted to talk to you and wanted to reach out to you is because I'm a hardware founder focusing on hardware for medical purposes. I'm not gonna try and go deep into what our startup does, but basically what you've been hearing, or what we've been hearing, is that doing hardware is just generally a lot harder than doing a SaaS startup, right? So from a fundraising perspective, how different is it to try to get money as a hardware startup compared to getting money as a SaaS startup?
Oh, extremely difficult. Compared to software, the barrier to, well, okay, let's just say that most investors have been trained with a set of heuristics to evaluate software startups. They've seen where software has gone. They've seen the potential of it, and they think it's just a more likely path to the venture-like returns that they're expecting.
Yeah.
I see software as a heck of a lot more competitive. I find it personally very difficult to figure out which software platform's going to win over another.
Yeah.
And the nice thing about hardware is that it's a little bit more unique. It's a little bit more differentiated. There are greater competitive moats around it.
Yeah.
Even if you're not necessarily medically regulated, you still have to build something. You still have to build it efficiently. It still has to work properly. There's still all sorts of complexities going from, design to prototype to mass production. And it's a lot more difficult for competitors to try to, copy what you're doing versus, if I build a software startup, tomorrow Notion or Slack, might just copy what I do, or Microsoft in general. I mean, you see what they do every time there's a interesting feature, they just build it into, Teams and their other software suites. So OpenAI kills something like 100 startups a week. Yeah, OpenAI can't kill your hardware startup just yet.
I gotcha. So, like, I guess a key advantage is your defensibility and your competitive mode, right? But I guess one key challenge for hardware, especially at the beginning when you don't have a lot of money, is it's a lot harder to iterate because you can't just change a couple of lines of code, right? If you want to iterate the hardware, you have to build it again from the ground up because changing adding a feature to a hardware product might require you to change the entire design, even though you're just adding a feature and not even removing one. Um, and that makes hardware development timelines completely unpredictable. From your experience with your portfolio companies, what have been the strategies that founders have implemented to kind of mitigate this, I don't know, downside?
Well, let me count the ways. About half of our portfolio is hardware, and I think you can find as many strategies as there are portfolio companies. But if I were to say, modularity is one strategy. If you can kind of at least try to design fix the framework by which you're building your hardware on, that's really important. Number two is don't outsource immediately. Keep stuff as much as you can in-house or at least locally. So you'll try to save a few bucks by getting your PCBs printed in China, but then you realize you've got 6 weeks of lead time between iterations. And well, guess what? You've just paid your salary and rent and utilities for 6 weeks. And that's a heck of a lot more expensive than, going down the street to one of the local DFMs and seeing if you could get a PCB done there.
I got you. That's interesting. Not because a lot of the things that you really need in hardware, you need so many different types of skills, like what you mentioned, DFM, and I think that's one skill that most hardware founders lack, right? Because DFM is a very procedural process. It's very procedural. Yeah. It's a lot of legwork. It's a lot of time. So when would you, and it's something that you usually have to outsource.
Yep.
But you're saying that you shouldn't do it, especially at the start, I guess, pre-MVP.
Well, you need, okay. So I've slightly misspoke. I should have said an ODM instead of a DFM step after. That being said, you should get in your brain how to DFM from day one, because it requires a different set of thinking skills. Because if you try to say, hey, this, sky's the limit, let's make this thing just work, you may realize that you have to redesign everything from scratch in order to make it DFM to make it mass producible.
Yeah.
I don't know what the right strategy is. It really depends on what you're trying to build, in that if your key milestone is to prove this is possible at all, then, having a DFM mentality from day one might be a little bit too difficult. Whereas if you're trying to do something that's combinatorial or something that's theoretically quite feasible to do, then maybe thinking about DFM from day one is probably a better strategy. It also depends how experienced you are as a team and how much of this you can outsource versus not. It really depends on so many different variables. But I'd say the strategies in hardware that have worked, at least in our portfolios, to keep it simple. Keep it really simple as possible. Offload as much processing as you can to your phone. As much, data exchange as you can off your phone, because you do have a supercomputer in your pocket that's fairly standardized. But again, it really depends on what you're doing. If you're doing, soft robotics like you're doing versus, a widget or an IoT sensor, that's a different game.
I gotcha. Oh, by the way, for the benefit of the listeners out there, DFM stands for Design for Manufacturing. So that's a process wherein you convert, or I guess you design the product such that you can produce it en masse. Is that okay? Yeah. Yeah, cool. So going back to fundraisings, and I think this kind of follows from what we just discussed. I think in order to get a successful fundraise, you have to remove the technology risk, right? Especially at the seed stage. Would you say
I
that's
think it
right?
really depends. So you can find as many investor preferences as you can find investors, and some investors love technology risk because they think that they have a better way of judging it
I
than other investors. In our case, we don't necessarily like scientific risk, but we're okay with technology risk as long as we see kind of a path from, prototype to being out there in the real world. I mean, if there's a critical manufacturing step that just doesn't exist today, that's not going to make us very comfortable.
Okay. So can you just help define that for us? What in your head, what is the difference between a scientific risk and a technology risk?
Um, well, for my background, which is more, actually exclusively healthcare technology, scientific risk is, can we use this signal to detect a clinical parameter? Or um, can this change the outcome of a disease if we do this intervention?
Mm.
That's kind of scientific risk. Technology risk is more like, can I take this lab experiment that's split across my bench, that's a series of independent modules wired together and stuck together with duct tape and bubble gum, and make it into a form factor that would be consumer friendly?
I got you. So let's say you have a promising startup, but there's still a bit of scientific risk. And usually, in order to de-risk that, right, you have to do a lot of development, which involves burning a lot of cash. Do you have any suggestions on like how someone can go about doing that without necessarily burning their wallet?
Yeah, this is where non-dilutive funding has traditionally played a very strong role. So here in Singapore, we have POC and POV grants,
Yeah.
for example. In other parts of the world, you'll actually have, let's say in the US, you have NIH funding
Yeah.
to take it to a certain level, right? I think it's the realm of academia to de-risk the scientific part of it. And if you're not in academia, then there are actually industry grants available in most places that operate.
I gotcha.
Even a startup in Romania right now that we just invested in, has a lot of granting options available to it to do some, R&D. I think in Singapore you also get tax credits, if I recall correctly.
Yeah, there is.
Yeah.
And Tech SG grant or the SG Tech grant from Enterprise Singapore. Yeah. So when it comes to de-risking, do you need to see prototypes, or are you okay with just looking at experiments or something like that?
We're a fan of prototypes.
So something that you
Yep.
can actually.
Yeah.
Okay. Maybe put it this way. So beyond that, let's say, just for the case of example, I'm working on a nuclear fusion reactor. So obviously, making a prototype would cost everything and more than that. What other types of data points or metrics would be useful in possibly convincing an investor that this is worth building before the prototype stage?
Um, so I wouldn't necessarily invest in a startup like that, but
I see.
if I would want to see, hey, is the founder really smart in nuclear fusion? Do they understand the different approaches by which you could do it? Have they had prior research careers that would give credit to the hypothesis that they are working on right now that could lead to a prototype? And for some people, hey, that's enough. That's enough. And again, as I said, you'll find many different investors with many different preferences and risk tolerances.
I gotcha. Okay, since we're mostly located in Southeast Asia, maybe let's try to frame it from a startup that has no choice but to raise in Southeast Asia, for example. So
I would challenge that.
really,
I've seen lots of startups from Southeast Asia raised from outside Southeast Asia, even at their inception rounds.
oh,
The internet's a big place.
I gotcha.
People can get on planes. People can go to conferences.
And
People
raise-
have uncles across distant lands.
I gotcha.
You shouldn't, I mean, yes, proximity is certainly something that may make your life easier, but let's go back to your nuclear fusion example. if the leading fusion experts in the world are located at CERN, and maybe the funding that funds them is also located around CERN, and you want to do something in fusion, maybe you got to hang out in CERN for a bit.
I gotcha. That's true. I mean, that's where the talent and money is, so you have to go there.
On the contrary, usually when people do raise their very first round of financing, it comes from the quote-unquote 3 Fs, which is friends, family, and fools. And, friends, family, and fools tend to be down the street from you or in your house.
I gotcha. Yeah, so let's explore that a little bit. So does it usually take for you to be able to raise outside of your home area? Is there anything special that you need to do? Like, for example, if you want to raise in the States, do you need an LLC in the US before you can do that?
Not necessarily, but again, it's about friction.
Yeah.
Every little thing that makes an investor have one less reason to say no will increase your likelihood of a yes.
I see.
It's just logic. So Americans, what is it? Like half of I forget what percentage, but it's like pretty high of Americans don't even have a passport.
Yeah.
So investing in something outside of a US LLC might be really difficult for them because they're like, oh my God, how's that impact my taxes?
I gotcha.
Right.
I see.
And even from sophisticated institutional investors, there's still questions about like, oh, how do I invest in Singapore? Is it safe?
I gotcha.
It's like, of course it's safe,
Might be safer than investing in the States. Or I don't know.
No, I don't know. Elon just got his $50 billion pay package struck off by a Delaware judge 5 years after the fact. So
yeah, that took a long time. Didn't he already spend that?
Yeah, I think it's called X now.
Okay, let's swerve around that before we get a little too deep on that. So one of the things that I've heard from my mentors and people around me in general is that raising outside Southeast Asia is the risk tolerances, based on what I hear, are a little higher. How true is that?
I want to say it depends.
Okay.
But if I were to grossly generalize, I would say the risk tolerance is higher in markets where you have more success stories of entrepreneurs. And the 2 places in the world where, actually, sorry, I should say 3 places in the world where we've seen that, I guess, disproportionately the US, China, and maybe arguably recently India.
Oh.
But each has their own nuances about them. But if we talk about, the, I guess, modern Western order and what much of the economic frameworks are designed around, it'd be the US.
I got you.
And of course, China recently has had some economic challenges.
I see. Okay, that's interesting. So, okay, what I'm actually trying to get here is that I'm trying to get into the mind of what makes an investor say yes, right? Like, what is the mathematics or the calculus in your head that you use to kind of gauge, build a scoreboard or build a score about the startup that you're evaluating? But maybe interestingly, one way to put it is, let's take a look at it from your perspective exactly. So let's start with a fund. Yep. So usually when you invest, correct me if I'm wrong here, you also look out for other investors called limited partners or LPs. They invest in you, you manage it, you build them a fee, then you invest the funds that they invested in you, and hopefully you make a return. How does that process look like, and how does it differ from what a startup does when they're raising capital?
It's pretty similar. I could make the argument that it's a little bit harder, in that you as a startup only need 1 or 2 investors per round.
Yeah.
You call it a day. And how many investors did you have to talk to get those 1 or 2 investors?
These days, maybe 100.
Yeah, it's between like 20 and 200, right? Yeah. Depending on that. Now, if I'm raising a fund, it's very unlikely I'm going to get 2 limited partners because they're my bosses now.
Yeah.
They would, because unlike a startup, you would sell off 10 to 25% of your startup each round.
Yeah.
A fund is 100%, well, almost 100% investor owned. I mean, of course, as a general partner, you would put in some of your own commitment, show you have some skin in the game, and of course get to benefit alongside if the value goes up. But 90 to 99% of your fund is external shareholders. So if you only have 2 shareholders, that's a very big power imbalance.
Yeah.
Also, from reporting requirements, your fund isn't the ultimate beneficiary owner. It is those 2 very large LPs. So you want to have a base of limited partners of at least 10. Typically, what you see in funds, somewhere between 25 to 100. Now, let's not talk about decision making and psychology just yet, because we will. If you are trying to get 25 to 100 investors, how many conversations do you need to have in order to get 25 to 100 investors?
I want to say 1,000.
Yeah, 1,000 to 2,000 is probably what I've seen.
Yeah.
Not just with our own efforts, but also with the efforts of my peers, which I'm close to. Some people are really lucky if they're on multiple funds. They have already a captive base of investors say, hey, I'll re-up with you. But if you're starting out, if it's your seed round, so your seed round is like fund, your first fund, right? It is a difficult journey because you do have to talk to a lot of people and convince them that they're going to make more of a return if they're financially motivated, more of a return than if they were to invest in you directly, because people don't think about risk and return so much. Mm-hmm. It's much harder to lose your money in a fund than it is to lose in a startup, because if you invest in 15 companies, what's the odds that all 15 are going to go to zero?
Yeah.
Versus the odds of one company going to zero. However, a lot of folks, especially if they're more entrepreneurial nature, like to invest directly because they're like, hey, I know exactly what I'm putting my money into. Whereas a fund, it's like, all right, you've been very successful. Why don't you give me some of your money so I can invest it in whatever I want? And, give something back that you couldn't do yourself. And if you're a successful entrepreneur, that's a very difficult proposition, because it's like, look, I'm a successful entrepreneur. I can make lots of money. Why should I give it to you?
I gotcha.
Yeah. Now, there are different kinds of investors, plenty of different kinds of investors. Some are like, yeah, we tried direct investing. We're not very good at that. So I think we'll do funds. Or we want to get to know companies for a really long time and de-risk, so we can invest in a fund and then directly invest in that company later when it becomes a little bit less risky to do so, and we can deploy a more meaningful amount into it.
That's interesting.
Or we don't know what the future looks like. It's strategically advantageous for us to have multiple insights on where the future may go, so we'd invest in a fund in order to do that. Or we like you guys, which is also a lot of why people invest directly in startups, is they like the founder or they like the founder's mission. So there's many, many reasons. And as such, there are many, many heuristics by which an investor would make decisions.
Oh, yeah.
Is it financial or non-financial? That's the first barrier. Or in that spectrum, where do you sit? And if you're non-financial, is it strategic, or is it due to the mission or the impact, or personal?
Yeah.
Right?
I think that's a very interesting way to put it, because not only do you have to beat like the basic financial instruments, like maybe an index fund, obviously you have to beat the S&P 500, right? But it's also interesting to kind of know that, because the people that you want to invest in you are themselves very successful business people, and you have to beat their ability to make money out of their money. So you have to beat them as well. So that's a very interesting proposition. So how, for a startup to convince an investor that they were investing in, so you make a blueprint for growth, right?
Not necessarily. You have to understand what motivates them. Yeah. You can't always assume it's financial in nature, and you can't always assume it's maximum alpha. Maybe it's like, hey, I'm a successful entrepreneur. I'm going to make really risky bets directly in companies, but maybe I'll invest in a fund. And I wouldn't even say a venture fund, just a fund, to say, hey, you're going to be my backstop. You're going to be my safe space.
I got you.
I'm going to swing for the fences, but I want something that will give me a low risk, consistent return. That's one example. And we call that a barbell strategy, where you're going for extreme tails of risk, right?
Yeah. Okay.
You know, it's like you invest in, I don't know, venture built or first capital startups and put money in T-bills, right? That's probably the most extreme ends of the examples, and there's permutations within. Or you invest in public equities that pay nice dividends, and you do some angel investing, right? Again, it's all about portfolio allocation, which I don't think we'll have time to necessarily get into, and it's really about risk reward tolerances and how you construct your portfolio based on that. I guess slight disclaimer, this is not financial advice. This is only for informational purposes and should not be misconstrued as the former.
Are you required to say that?
In some places.
Okay. No, I mean, I think it's just really important to get into the head of the people that you're talking to, right?
Yeah.
So it's important to not only just understand what you want, but understand what the person on the other side of the table wants, so you can connect with them. Which I
would start with that first, actually. Yeah. People will buy what they, well, rather, you should sell what people want to buy.
Yeah.
And if your counterpart on the other side of the table isn't interested in what you're selling, then you shouldn't waste your time, or you should try to figure out what they're interested in buying and see if you can kind of find a way to solve that problem. And sometimes the bridge's too far. It's a bridge too far.
Yeah. So you just move on, right?
Yeah.
So that's kind of interesting. And I want to go back to the two archetypes that you described before, a founder before, the missionary and the mercenary. So based on my experience, you can't be 100% like a missionary. You can't force your vision completely unchanged from the start and expect the product to come out of it. You have to tailor it a little bit to what, or actually a lot, to what the market wants, to what an investor wants. So
it depends. You could be lucky.
Well, that luck plays a part in there again. So to you, what's a good compromise for personally? Like if you're talking to a missionary founder who really wants their vision as they see it in their head to be what ultimately comes out, what would you say to that founder to kind of like tell them, hey, you kind of need to be a little flexible here? Or what do you think would convince someone like that?
I think in an era where capital was abundant and cheap, you could kind of give them a bit of latitude to play it out.
Yeah.
Because maybe they're right. Of course, you want to have market validation for this. You want to have corroboration that the key stakeholders will find this as useful as the founder says it will be useful or hopes it will be useful.
Yeah.
Even still, there is the potential that they get it completely wrong. But of course, if it's validated, it's a lower chance of it being completely wrong. In this environment, if that North Star takes a very long time and a large amount of money before you figure out whether you're right or wrong, you do need to have some more near and midterm strategies to create a viable business. Right?
Yeah.
So let's say you've invented a widget, and this widget's really good at diagnosing a migraine and monitoring a migraine severity, but you need 5 years of R&D to prove out the algorithms. What else can you use this widget for?
I got you.
What else can you use this widget for tomorrow, next year, the year after that? And in our space, before a company is regulated, it's very difficult to make revenue. However, it's not impossible. So you could have a widget for research use only. Maybe you need to measure these signals in mice to see whether, hey, it's scientifically useful. Sell a few devices to some labs. You need no FDA for that, right? Let's say you're some really talented engineers and need to invest in some capital equipment to make the widgets.
I got you.
Would, say, other startups find that equipment useful, and could they, maybe use your equipment while you're not using it instead of them buying the equipment themselves? That's service revenue, right?
I got you. So it's kind of like also not just maybe refining the vision, but also the path to the vision. Instead of making one grand product, you make the product in bits and sell it in bits until you make a magnificent product that ultimately fits your vision. Is that right?
That's one way to go about it.
Yeah.
But you also have to have some backup plans in case that vision turns out to be wrong.
That's true.
Like not just like drifting, but like completely wrong.
That's
And
true.
then, the question is, do you keep going with these other things you can do with it, or do you say, hey, you know what, I'm gonna call it a day. I'm gonna give back money to investors and try something else in the future.
I gotcha. So one of the things that you just mentioned, and again, I want to switch gears here, is the market right now. And I presume you're meaning that we are in a very, very cold, almost frigid market. Is that right?
Yes.
Okay. So obviously for a lot of the founders that are listening to this, we haven't experienced the hot market. How different is it?
I think a market, when it gets frothy, creates a lot of future pain. It kind of, the pendulum swings in extremes, and when it's one extreme versus another, they're both bad.
Yeah.
I mean, personally, okay, if you do a startup during a frothy hot market and you cash out, wonderful. You don't need to ever work again. Or you can set aside that money and wait for the market to cool and then invest in some cool stuff when it's, when it's a buyer's market, right? A lot of companies got created that shouldn't have been created. A lot of capital got wasted.
Mm-hmm.
And, the repercussions of which we're living with right now. And while investors got their fingers burned, they're now kind of reluctant to participate because of that, recent pain.
I gotcha.
So, and the other thing with a hot market is, if you have raised and you're running out of money right now, it's really painful, because if you haven't grown into your valuation,
experience a down round.
Yeah. Down round or not, maybe your investors have egos and they don't want a down round. Maybe they'd rather see the company just kind of like disappear, not talk about it.
Has that happened?
Not to us, but I have anecdotal evidence of such behaviors.
Wow.
Yeah, it's pretty crazy, where people just are completely allergic to the concept of down round that they just would rather sink the company, or so incredulous of the down round that they would stretch it to the last moment and the company folds.
Is that just an investor refusing to accept reality, or is just that really I would rather have my pride than my
Sometimes it's a failure to appreciate reality. Sometimes it's a bit of pride. Sometimes it's a bit of competition amongst peers, and it's like, you're gonna, if this goes down, it ruins my track record. I mean, and what if it's zero?
I mean, I could see
know.
them making the argument. Yeah, startups die every day.
Yep.
But you don't experience down rounds every day. I think those are a much rarer occurrence in the past, down rounds.
It depends where you are as well. Yeah. There are a lot of geographical variability. I think in the US, down rounds are far more frequent.
Really? Oh.
Yep.
Okay. Yeah, and in regards to hot and cold markets, like, what are some of the advices that you would have given during a hot market that you really wouldn't give now? So the angle that I'm trying to approach here is that you mentioned before that the internet holds a lot of information, a lot of tools. So one of my favorite sources of startup advice, was Simon Altman's blog, and some of those entries go back to 2013. And basically, how do you filter out the information that is not valid anymore?
Well, I think it's just any critical thinking. Think about the motivations and context of the words that have been put to paper or put to blog at that time.
Yeah.
Right? It's a critical thinking exercise. So some of the advice I would have given to startups in the hot period is, don't raise more money than you know what to do with. Because it burns a hole in your pocket, and there are expectations that come with that money. Unless your stakeholders are aligned with those expectations of like, hey, we're going to raise extra money to weather a storm, and we're just going to, put it in treasury.
Sure.
And just let it sit. That's fine. But if you go out and try to scale before you have a market, or if you have negative unit economics on your scaling efforts and hope one day they'll magically turn profitable, or someone will buy you before you need to be profitable, that's very dangerous.
So the growth at all cost tactic. Yeah.
And there was this, strategy where it's like, okay, if you have something interesting, just take the market. I'm going to give you lots of money and just take the market.
You mean market share? Yeah.
Yeah.
Just grow a ridiculous amount of market share despite the fact that your unit economics.
Yeah, because take out your competitors, outcompete them, and just be the winner takes all approach.
And then fix your unit economics at a later date.
Yeah.
Yeah.
Very few companies have managed to pull that off. Uber's pulled it off, I think.
Have they? Well, I mean, they're big.
Yeah.
And Amazon, I think, also did that for a while.
I feel like
they didn't go negative, but
no. Amazon was always trying to aim for a net profit of 0.
That's interesting.
Yeah. They were growing super aggressively, but I don't think they ever went into negative unit economics.
Yeah, that's what I meant. I mean, they didn't aim to be profitable, but it's still a growth at all cost mentality, right?
Well, not all costs.
Well, break even cost.
Yeah. They were always going for break even. At least my understanding of the history of and psychology of what Jeff Bezos was building.
I gotcha. So one of the reasons why I ask is I still know people who want to adapt that mentality right now. Can you lay out a hypothetical? What do you think will happen if they do it now? Like besides run out of money, like how is it gonna look like on the path of running out of money?
Honestly, it really depends on what they're trying to build.
Mm-hmm.
I mean, the bubble right now is AI.
Yeah.
And you've got people that are buying hundreds of millions of dollars of chips, and they're racing to, who has the biggest compute, who's got the biggest model, who's got the greatest training data sets. And I don't know how that's all going to play out, but what would happen if, I don't know, someone makes a chip that's 10 times more efficient the next day, or someone makes new hardware or something that would then obviate all that capital spent.
I gotcha. But do you think there's any kind of startup idea right now that can still justify a growth at all cost mentality? Like, let's say you have something so revolutionary that can really.
Well, I think it's the LLMs. I think that was the growth of all costs. That's what we're seeing right now
with OpenAI.
Yeah. It's not a place that I'm comfortable with. It's not a place I play.
And do you think it's just that? And do you think is it really because LLMs can be just so game changing, or do you think there's a hype component here?
I'm not sure, because LLMs can be game changing. I don't know if you saw the Sora videos. They're just outstanding. I mean, we're basically an incremental few steps away from a holodeck.
Yeah.
And customized video games, or customized everything, and living in a post-truth world where I don't know what's real anymore unless I can actually touch it and see it with my own eyes.
I gotcha.
Right? At the same time, there's incredible hype. I don't know the answer.
I got it. Well, I think I also wanted to end with this and using hype.
Yeah.
Like in this current market situation, especially for hardwares, can promise absolutely mind-boggling things. Like, let's say nuclear fusion again.
Yeah.
Should you try with the current market? Should you even try to use hype to kind of boost your valuation or boost your investability? Is that a word? Or should you do what other companies are doing and just maybe keep it down low, maybe even do stealth and emerge later with a good business plan, maybe good net margin?
You're not gonna like my answer, because again, it depends. Depends on the kind of investor you want to get. It depends on how good you are at hyping, or how good you are at executing. I think in my own personal preference, it's consistency. It's, are you consistently building? Are you doing what you said you're going to do? And if we check in on you 3 months later or 6 months later, are you still doing it?
I gotcha.
Have you changed?
I gotcha.
And if you do change, was it for a good reason?
All right. So much like everything in this world, it really seems like it's really up to you and what you're doing, what the startup is, who the founders are, what the market situation is at any given time. Yeah. Yeah, I think that's all I have right now. It'd be interesting to see if you have any questions for me, though.
Well, how's your journey been?
Sorry?
How's your journey been? So you're doing a hardware startup.
Yeah.
Have you tried to raise money yet?
I mean, we're always trying to raise money. Just keep up. Try to keep your hand on the pulse. Try to know what investors are continuously looking for, whether how you stand with investors. So we've had some successes, and it's not always been successful, but thankfully we did have some successes. But the entrepreneurial journey for me has been really, I want to say, game changing, because before I did this, I was doing my PhD in NUS, right? But and man, I thought that was hard. But now I was like, sometimes, can I go back to doing a PhD? I think that's a simpler time. But honestly, from if you allow me to get a little philosophical here, I wouldn't trade this for anything. This has really been one of the most significant things I have done in my life, and it's going to be hard to top, basically.
Cool.
Yeah.
Wonderful.
Yeah.
Good luck.
Thank you.